What's good, YouTube? Welcome back to the Stock Hustle channel with your boy William. Today is Tuesday, October 26th. So, as everybody already really knows, I like to emphasize it even though it's stated in every single video. Nothing that is discussed on these videos, guys, is financial advice. It is simply financial education. I'm simply trying to teach people how they don't have to slave in that 9 to 5 that they hate. Instead, they can simply hustle 24/7 in the stock market and accomplish all their financial dreams and goals they ever thought or imagined. Literally, that is a fact. Anybody can trade in the stock market. If I can do it, damn it, anybody can do it. That's a simple fact, right? I'm not the smartest, I'm not the brightest, but I am determined and persistent, and I do not ever quit. I didn't care when I first started learning investments a decade ago. If it killed me, I wasn't going to give up. Even no matter how much money it cost me or how much money I lost, I wasn't ever going to give up. I was going to eventually learn it and become profitable. Here we are now, a decade later, and now I have a YouTube channel. And now I'm trying to mass teach people. I did the ones and twos, the family and friends, the co-workers at work, blah, yada, yada. And everybody's been successful so far. So I figured, why not give this to other people who might find it beneficial in mass, and put as much good karma into the world as I can. I'm a true believer in good karma. If you put enough good karma into the world, eventually she will come back to you twofold, right? I'm also believe in good vibes, right? I don't have any negative desire in anybody. I don't want to nickel and dime people. Nothing that I offer people comes at a cost. I don't get paid for none of this. This is literally true hobby. I have a hobby in the stock market and investing specifically. For researching stocks and investments and for options. I'm super deep into options. I love options. I love the way they function. I love the way they work, which brings me to today's video. So recently, in the last couple of weeks, I've had a significant amount of people message me, tweet me, or ask me, hey, what is an option and how does it work, right? Now, as I mentioned to you before, I've taught people here and there. I've taught family and friends. I've taught coworkers, right? It takes time. Like, it's not easy to learn a financial instrument. They're financial instruments for a reason. They're complicated and they're complex, right? Why? Because that way it'll take the people that aren't serious about something and it'll weed them out. It'll only leave the people that are truly serious about something, especially in finance or in money, and it'll weed out the ones that aren't, right? Why? Because you only want people that are serious dealing with money. Because there is risk associated to it, right? But as they say in the stock market, if you aren't familiar with FINRA laws, please get yourself familiar with them. An investment can't go to zero tomorrow, right? There is no FDIC insurance. There's nothing to protect you from taking a loss, right? It is pure risk. You're assessing risk versus reward. Every trade has risk and reward, right? It's your job as an investor to make the determination of what is the best for you, and how much risk you're willing to tolerate, and how you're willing to manage risk. That, I know that's getting a little complicated. I'm not meaning it to. It's just the simple fact, right? So we know that's established for stocks. Options, as you see a lot of people in YouTube, specifically YouTubers, tell people, stay away from options. They're super risky. Yes, that is true. They're super risky. They're more complex. They're more complex than even a stock, right? I can go buy a share. You know, looking at this ticker, it cost me $19 a share to own one share. I buy 100 shares, that's $1,996, right? What they don't tell you is that there is a more affordable way to take control of those same 100 shares at a fraction of the price, while at the same time being able to make significant more amounts of money if you understand some fundamental principles. So I wanted to take this opportunity today to record this video. This is going to be an options 101 crash course for anyone that's new to options. If you already know options, you might want to skip towards the end of the video, where I might touch base on some more complex strategies in relation to options. But for the beginning part, it's going to be literally buying calls, buying puts, the Greeks, implied volatility, and that's about it. Because again, teaching options takes time. Most of the time, or most of it, is practice with it, right? Like, you guys are going to initiate trades and you're going to maybe lose, right? Especially when you're new, because you don't necessarily know what you're doing. And if you just try to rush into something, I guarantee you're going to lose, because I know I did. That's just me. I have to learn by hands-on. Like, I have to do it in order to fully understand it, which in that, all that should translate to you is this idiot literally went out, bought options, not fully knowing what he was kind of doing, and lost some money. Sure did. Yep, honest, guilty as charged, whatever. I don't care. It put me in the position I'm at now, so it's not a problem to me, right? But I did go ahead and draft up some options crash course fundamentals, right? These rules, if you want to take a screenshot of it, you can. You don't have to. I'm going to actually publish this on my website, which I'll show you guys towards the end. Yeah, I do have a website where you can actually access this information anytime you want, right? So I'm going to go through some brief information. I'm going to skip a couple pieces, but at the end, I'll touch base back on it, right? So what is an option? An option is a contract. Like I just told you, I can go buy one share of Sophie and it costs me $19.96. If I buy 100, it's $1,996. Well, they also do options. I can go buy one option contract and that gives me control of 100 shares of Sophie. There is no commitment, you see right here. No commitment to buy the shares or not buy the shares or sell the shares, right? It's just a contract. That contract comes with a premium. So for me having that contract, I have to pay a specific amount of money. Now, let's talk before we get deeper down that road, just fundamentals. Buying a call is a bullish sign. That means I want the stock to go up. If I buy a put, that is a bearish sentiment option, and I want the stock to go down. This is where I'm going to stick to today because I don't want to confuse anyone. And these option contracts can get pretty confusing, especially when you start mixing strategies. So, again, buy a call, bullish. Buy a put, bearish. That's all you need to know. Now, contracts. Each contract is worth 100 shares of any given stock. Whether that's Sophie, whether it's AMC, whether it's GME, whether it's UPST, whether it's Visa, it doesn't matter. If I buy an option contract, that option contract holds 100 shares of that given stock that I'm interested in. Understood, right? Simple. Again, there is no commitment. These contracts can be sold minutes after buying them, hours, days. You don't have to hold them until expiration. Yes, every contract carries an expiration date. Think of it like, I hate to use this example, but I mean, it really is. Like, think of it like a prop bet. You are betting that a stock will hit a certain amount of money price by a certain amount of time. And for that, you're paying a fraction of the price to control 100 shares of a given stock. Very simple. It's a crappy example, but it works because a lot of people understand that because a lot of you guys are involved in DraftKings and all the other sport betting apps that are out there, right? Premium. So to buy a contract, I have to pay a premium. Premium is what either the bid or the ask is for any option chain you go into, right? This amount of money is called premium. It's either you are paying premium or you are being given premium. And that's all I'm going to say as far as that. Again, I'm trying to keep it simple to not confuse people. Premium is paid to open a call or a put, which goes to the person holding the shares. Yes. Whenever you are being paid premium, right, that means you have shares and you're selling these contracts. If I'm buying the contract, that means I want potentially the shares. So that's why I'm paying the premium, which will go to the person holding the shares or the institution holding the shares, etc., etc. Simple as that. You are paid premium for opening a sold call or put. Yes, as I just explained previously. You can use options to hedge against your shares. Yes, this is a strategy you can do if you hold significant amounts of shares. What does that mean? I have 1,000 shares of Visa. We can look at the chart. Visa essentially been trading flat here at this 220 to 236. Hasn't been really doing much. I want to try to lower my costs for all my shares. I can go in here into an options chain and I can sell contracts literally every single week. As you see, there are weeklies, these yellows. So I can say I'm going to sell this $235 contract. I'm going to collect $230 in premium every week. And if Visa never hits 230, I get to keep the premium. And overall, I'm lowering my costs for my shares, right? So instead of spending all those thousands of dollars, now I spent less because I'm getting premium every week. People use that as hedges, right? There's different ways you can do that. That's a strategy. I don't want to go down that road. Just simple explanation, right? We'll keep going. Decay. Decay is applicable in all forms. Yes. Whether you buy a call, whether you buy a put, whether you sell a call, whether you sell a put, each contract carries theta, which is the Greek specifically for decay. Your contract loses money every single day. We'll get that in a minute when we talk about the Greeks. There is an expiration applicable in all forms. Yes, whether you buy a call, whether you buy a put, they have a term or a completion date. Contracts cannot go for infinity. Like, you have to have a certain amount of time. If we're looking at this options chain, we're looking at contracts expiring October 29, 2021. We could easily look at a contract that expires December 17th, 2021, right? There's always going to be an expiration date applicable to each option contract you specifically buy. Implied volatility is applicable to all forms. What is implied volatility? That's an excellent question. Implied volatility. The term implied volatility refers to a metric that captures the market's view, the likelihood of change in a given security's price. Investors can use implied volatility to project future moves and supply and demand, and often employ it to price option contracts. So implied volatility is used to price option contracts. How? Like this. This is called a standard deviation, or one standard deviation move. Take a price of a stock. In this example, it's $50, right? It has 20% IV. $50 times 20% IV equals $10. Starting from the middle, $50, $10 going up gets you 60, $10 going down gets you 40. So with 20% implied volatility, what you're doing when you look at a stock is you are essentially telling yourself, okay, I now understand because of 20% implied volatility, this could be 60 or this could be 40, because that's the implied volatility of a potential move to the top side or the downside. It's applicable because every options chain has it designated. For Visa, it's 27%. That's close to this 20% here in this example. That's why I chose Visa, right? It's pretty close. Some have IV that's like 123, 125. Everybody's favorite AMC, what's it at today? 124. What's GameStop? GME. GameStop is sitting at 89.94, right? And so forth and so forth. But each options chain has its own applicable implied volatility that's important for you to know. It's important because you need to understand the size of the swing, right? You always want to know that. There is risk involved in all forms of contracts. Yes. As I stated, just like a stock can lose its value tomorrow. There's nothing guaranteed or nothing propping it up that it won't. Now, you can invest in things like Microsoft, Google, right? Apple. Those companies aren't going to go bankrupt tomorrow unless they do something really, really stupid or they make a very, very critical mistake. But for the most part, you understand or can tell what is safe and what is not, right? Applying in this new technology called Axe computers, right? And they're going for 100 a share. I mean, if you're willing to take that risk, cool. But you're taking the risk. You don't even know this company. You don't even know the name. I literally just made it up. Like, why would you do that, right? You might want to do some research first, which is why you always see in the videos, I do research for you guys. What institutions are buying? Who's short? What catalyst came up? What are analyst projections, right? I try to give you as much concise and consistent information consolidated into a video so that you can make a better financial decision for yourself. You know, educating people, that's important, right? But yeah, there is risk involved in all options. What's the risk? The premium that you pay can be lost completely. What does that mean? So I'll use AMC because I have a ton of option contracts in AMC. Long-term leaps. Leaps are just basically a long-term contract of it's 6 months or more, generally a year, right? So I have leaps in AMC. What does that mean? Well, that means that I went out here into this option chain and I was looking either at January 2023 or January 2024, right? Or June, July 2022. I have a couple in each section. But specifically, when I go in and buy a contract, you see that there is an ask and a bid, okay? The ask is what people are asking who have sold these contracts, right? So if I turned around and have the shares, I sell the contract, I am asking for a price. If I am bidding, I am a buyer and I'm willing to pay this, right? What's in between them is called a spread. It's not necessarily important for you to know, but it is terms, right? So you understand. Well, when I want to buy, let's say, this $43 contract, this $43 strike for July or June 2022, that AMC will hit $43 by June 2022, I have to pay premium to initiate this contract. This premium is going to cost me anywhere from $945 to $985. But Will, it says $9.45. Yeah, but remember, each contract holds 100 shares. So this number is multiplied by 100. $9.45 times 100 is $945. That is the premium I am paying to essentially hold this contract. That premium is my risk. That is something I am risking to potentially lose if this contract goes south. Right. Okay, but ask yourself, what would it cost me to own 100 shares of AMC right now? Well, right now it would cost me $3,605. So $3,605 for 100 shares, or $9.80 or $985. Which would you rather pay? Because again, either way, I'm going to hold this essentially until June of next year. That's at least 8 months. Right? So which would you rather be debited? Would you rather lose the $3,600 out of your account, put it to the side, and now you know it's sitting there at least until June of next year? Or would you rather just lose $985? That is a decision each one of you guys will each independently have to make as investors, right? This is why options, it's important to know options, because it opens the door for possibilities, right? You don't always have to play to next week or next Friday's option chain. You can play this long term, right? Instead of spending $3,600, you can spend the $900. Now I have the same control of the 100 shares, but what's the difference? Okay, well, what the difference is, I saved $2,600. Instead of buying the 100 shares of AMC, I bought the option. I saved myself $2,600, right? Now that $2,600, I can go buy another option contract of GME, and then I can go buy one for BlackBerry, and then I can go buy one for Better Bath & Beyond. But that doesn't help the movement. That's right, it doesn't. Buying option contracts does not help the movement. The purpose of AMC and GME and all the meme stocks is buying and holding. That is true, right? So that, I'm not going to lie, I'm not going to fed on. It's true. But that's not the only two plays on the stock market. We just talked about Sophie. I just covered it in a video. UPST is another video I just made. ChargePoint, CHPT. Blink. These are all options or tickers in the stock market you can play outside of meme stocks, right? You can play these every single week if you wanted to, because each one carries an option chain. Each option chain carries different values. Depending on the price of the stock is the price of the options, right? Super high stocks carry super crazy high option chain cost premiums. Lower tickers carry lower cost premiums. You can literally go in here right now for this Friday and play a contract of Blink, and the cheapest contract is going to be $3. $3. And you have control of 100 shares that if Blink hits 40 by October 29th, you will make some money, right? Now, obviously, what's the distinction in them, right? Aside from that benefit of spending less to hold the same amount of value, right? What are some of the things that go into it, right? That specifically is where the Greeks come into play, which are these things down here. So Greeks, you have Delta, Theta, Vega, Gamma. Delta is important to me. I quote this in just about every single video of any ticker that I do. Why? Because it's how much money you make for each dollar that a ticker goes up. I bought this contract here for Sophie at $30, or Blink, excuse me, at $30. I paid $50 for this contract, as you can see here. It has a delta of 0.35. That 0.35 means two things. One, I will be paid $35 for every single dollar Blink goes up. So if tomorrow Blink goes up $2, I made $70. Number one, that's simple interpretation, simple explanation. The second meaning is this contract has a 35% chance of being profitable. And that's the part a lot of people sometimes don't know. The delta is also your profitability percentage. Yeah, that's why you kind of get now when you hear me say in videos, I don't play, or I try not to play anything that's not a 0.5 delta, 0.50 delta or better. Why? Because I want to have that 50% probability of being profitable, number one. Number two, you pair that with unusual whales in the flow, and that 50 really is somewhere like in the 70s or 80s. Number three, I want to at least make $50 for every single dollar that a ticker goes up. It's just going to benefit my pocket that much more. That is Delta in a nutshell. Yes, you might have to replay this video multiple times to fully grasp that and understand that. We'll keep going. Theta, how much your contract decays. Yes, when you buy a contract in an option chain, it comes with theta. That theta is applicable. Why? Because theta is how much money you lose per day. So the contract costs me 50 cents, right? Essentially $50. I lose 15 cents, or essentially every single day that this contract goes another day, right? So this theta is pretty high on this one, right? But as you can see, there are other thetas down here that are not as high. But generally speaking, when you have a high delta, it'll usually come with a high theta. Is theta something that truly concerns me all the time? No. Why? Because all option contracts carry theta. It's just something that is part of an option contract, right? So it's something you just need to plan for. Then you have Vega. How much risk of change in IV is what Vega measures. Then you have Gamma. How much delta changes with time. So Vega and Gamma, you've never ever heard me quote on a video. I look at them. I understand what they mean. Do I give them that much importance? No. Why? Because the tool that I use to favor what options I choose or don't choose is unusual whales. This is what is essentially curving the risk, in my opinion, to Vega, Gamma, and Theta for me. Why? Because I can see what big money is doing. I can see what medium money is doing. I can see what small money is doing. I can see just by their patterns and spending what they are doing to give me a better idea where I don't have to worry about Decay or Vega or Gamma, right? And this is why you never hear me quote it, ever. Because again, I don't care, to be frank, right? I obviously have experience in options, so I obviously understand the risks. I clearly understand, right, the risk and reward structure and how much profit I can make. So that's why I don't play importance into the risk factors, right? I'm not a negative thinking person. I'm an optimist. In case you haven't known that or noticed that, I'm always trying to be as positive and forward thinking as possible in everything I do, 100%, especially when it comes to my sons. They're probably the biggest influencer of my life and probably the reason why I am who I am now. But with that being said, the reason why you never hear me quote them, again, is because of unusual whales. Did I not have unusual whales, or before I had unusual whales, you better damn believe it, I was calculating the theta, the Vega, and the Gamma, because those are risk factors that make me lose money if I don't calculate or time for them right. And that, in a nutshell, is options chains. Now, please, if you take anything away from this video or for the last 20 minutes you've heard me rambled on, if you are new to options, please don't go into selling calls or selling puts. This is extremely high risk. So take the risk that I just described to you of high and multiply it times 1,000 when you go off selling calls and selling puts. In fact, it is so risky, it can't even be explained in this video to keep it a decent length. That would be another hour conversation just to try to explain how selling a call has a bearish strategy or how selling a put has a bullish strategy alone, right? If you're new to options, please just stick to buying calls and buying puts. Learn the fundamentals, right? Pick a ticker, even if it's one I talk about or one I don't talk about or one you just stumbled on, right? DNA, let's just say DNA. I have not made a video on DNA. I do have a position in them. I'm just going to use them for this example, right? Let's say you're bullish on DNA and you're like, you know what? I think DNA is going to hit $20 by January. You know what? Damn it. I think it's going to do it. They have a partnership. It's a biopharmaceutical company. They have a new cell therapy way of treating medicine and treating people. I think I'm pretty bullish on this company. I think that short report is horseshit. Perfect. Great. That's awesome for you, man. I'm glad. Now, you don't want to spend $1,400 to buy 100 shares, but you still want the 100 shares. You know what? I want to play some DNA and I want to play some SoFi. I think those two plays are, man, those are going to be some money makers. Perfect. Simple. You are bullish on two different plays. Use your money wisely. How can you play these both, right? First and foremost, when you're new, give yourself time. I'm going to emphasize that a lot. If you're new, don't play weeklies right away. You might as well just throw the money away, especially if you don't know what you're doing. And especially if you don't have an amazing tool like Unusual Whales in your stable that you're familiar with, don't do it. Give yourself time to develop and understand what it is. Yes, you're going to lose. Flat out. If you're new to options, you're going to lose money. Why? Because you're not as experienced to calculate the risk versus reward. That skill takes time. Some people, yeah, you can teach them a couple things here and there, and they pick up things immediately, quickly, and start becoming very profitable. Perfect. If that's one of you guys watching this video, I'm happy for you. I hope it goes that way. But for me, my recommendation, stick to buying calls or stick to buying puts. Puts when you're bearish, puts or calls when you're bullish. Again, we're going to use the example DNA. Excellent. So let's do it. I think it'll hit $20 by January. Perfect. You go in here, you look for the 20. Now you look at the delta. That's the first thing you should look at. That's the first thing I look at. How much money am I going to make for every dollar DNA goes up? Okay, well at 20, I'm looking at $27 for every dollar. At $17.50, I'm looking at 30. He said 0.50 delta or better. Okay, so that's 15. So for $15 that I feel that DNA can hit 15 by January, I'm going to spend anywhere from $145 to $170. Correct. That's what you're going to spend on this contract. You can highlight it here. I will make $50 for every dollar DNA goes up from now at 14. Perfect. I'm also giving myself a 52% chance of becoming profitable in this contract. Also perfect. You buy it tomorrow. Let's say next week DNA spikes $5. You literally will have made in a week or less than a week $260 on this one contract that you spent $170 on. Just like that. Just for DNA spiking $5. Let's say it spiked $15. So now you're talking about having made $780 on this specific contract in less than a week while only having spent $170, essentially saving yourself, what is that? $1,230 of having bought 100 shares of DNA. And this is just one simple strategy you can implement when buying options. Super simple, super straightforward. Let's say you're the opposite. I don't think DNA has got anything. I think they're a bunch of bullshit. I think they're going to probably go down to $10, to be honest. I'm very bearish on this company. I think they got a losing product. It's nowhere. It's not going anywhere fast. Perfect. Today we're sitting at 14. You're thinking it's going to hit 10. You can go in here and you can simply buy this put contract. Buy a put. You will pay anywhere from $105 to $135 for this contract. We'll just say $135. You will make $18 for every $1 DNA goes down. So if it drops the floor as you predicted, you would essentially made $72 in profit just on this contract, while having saved yourself essentially, right? Because again, 1,400 minus the 135, you saved yourself $1,265 to say or to be bearish that this contract or this company will go down in value. What can you do with that other 1,265? You can open opportunities for you. Now you can go out and buy other contracts for other companies. And this is where options becomes interesting, right? Now, that's just fundamentals, buying a call or buying a put. That's what I recommend any new options trader stick to in the beginning, just to learn fundamentals of delta. You learn strikes, you learn expiration, you learn a little bit about theta, you learn a little bit about gamma, you learn a little bit about IV. You start to understand what works best and what combinations, right? Now, you pair that with unusual whales and you will become deadly at options with time. Once you grasp the fundamentals and once you grasp how to use unusual whales and the amount of information this tool can provide you, it is a game changer for anyone in options. You can literally go through Twitter and find hundreds of people that have said it pays for itself. I am one of those people that have said it pays for itself because it truly does. This is a difference maker, 100%. So I know I threw a lot at you guys today. I know this is a lot of information to try to retain. You're probably going to have to listen or watch this video multiple times. Again, it's meant to be that way because, again, it's complicated. However, I want you each to know these rules. I have also taken the liberty of putting it in a public place, in a public space you can go to anytime you wish, any time of the day, and it costs you zero, right? Specifically, I have a website. If you go to my Twitter, it's stockhustle.net. If you go to my IG, it's stockhustle.net. No matter where you go to, www.stockhustle.net, it will take you to my webpage. In this webpage, not only do you have access to all my videos or my top videos of the week and the top 10 videos under episodes, there's a little bio section in the About Me section that gives you some background on me and some of the history that I have in money, involved in money, the most important piece is here under the blog. Under this blog, you're going to start finding a lot of different pieces of information that I'm going to publish. Specifically, today, I publish the option fundamentals for each and every one of you to visit if and ever you have a question or get confused. Again, it's free. It doesn't cost you anything. It's cost me time and money, and that's the way I want it for now. Eventually, I'll do some top 10 rules of buying stocks or top 10 rules of doing research or etc., etc. But this will be a running page, essentially full of information, especially for newbies or people that are new to investing that want to get into investing, so that they can understand at least some simple concepts that they can use to get them started on the right foot. When I started 10 years ago, I had none of this. There was nothing of this online anywhere, just about. It was rare to find any kind of peaceful or helpful information. Everything was either in books, or you had to know somebody who knew somebody who knew somebody who knew somebody, right? I'm trying to curve that for everybody and make it as simple as possible. I'm not saying I'm the go-to for everything. I'm not a guru by any means, but I know some things that I can teach to people that will help benefit them in the long run. But again, guys, as always, if you have questions, leave it down in the comments below. I'll be more than happy to get to you. Don't forget, you can always tweet me or DM me on IG. And as always, guys, I'll catch you in the next one.